I'm recording. It's not broadcasting, but we are recording that.
Okay, so you'll be up. Press play.
Yeah. So can you see the presentation? And me? Is that going to be a problem all the way through, that screeching, or is it just because the earphones went in? You can see the presentation of me, yeah? That's great, good to see. And I need to close those blinds behind me, don't I? Okay, hi everyone. I'm just going to wait a couple more minutes to give everybody a chance to arrive this morning. Grab a brew, a glass of water, whatever you have. Okay, we've got a couple more just joined and another one. So we'll just give it another 60 seconds. Beth's going to be here this morning, my colleague on the live chat. So feel free to reach out to her and ask her any questions as we go. Do you want to just say hello, Beth? Show that you're here. And if a couple of you just want to say you can hear me okay in the chat, just to give us peace of mind, that'd be nice. And just so you're all clear, I can't hear you, so everyone's muted in case you're worrying about noise in the background or anything like that. Don't need to worry about that. Right, okay, everyone, we're going to make a start. Housekeeping rules, first of all, if you just make sure all your notifications turned off on your laptop. I know how easy it is to get distracted during a webinar like this, but I'd like to get your full concentration for the next 45 minutes or so and give a little bit of time for Q&A at the end. So if you've got any questions throughout the presentation, feel free to ask. I'll probably leave them till the end so that we can keep the flow of the webinar going. But feel free to ask them and I'll come back to your questions at the end. If there's anything technical, Beth will be on it straight away. Beth's our marketing manager here and she's sat just in front of me and she'll deal with any technical issues that you've got as we go. And I'll jump on at the end for anything else. Okay. So for those of you who don't know, my name is Paul Barnes. I'm the managing director of My Accounts Place. I set up the business here about 4.5 years ago, and we are a specialist accounting firm. We just work with the digital creative sector. So all we do is help agencies to be more profitable and build the business that they're capable of building. I've got a little family, so that's my wife, Penny, and that's our little 2-year-old boy. He was about 1 then, I think. That was in Portugal. Nice little holiday. Benjamin's 2 years old now and running riot. And there's our team going out on our Christmas do last week. There's 18 of us now. So we have a team of effectively finance directors, finance controllers and bookkeepers. Predominantly work with Xero accounting software and we advise agencies. So this webinar today, I guess the overall theme really is about taking control of your agency. 2017 has been a really difficult year. Obviously, we've started working with more and more agencies and we started to understand what makes the most successful agencies successful and why many others are struggling. And we've also had some casualties this year of some agencies that were well respected and well renowned in the industry and are no longer with us. And I just wanted to put this webinar together to talk about the key metrics that will show you that kind of give you a health check on your agency and make sure that you've got your finger on the pulse in terms of make sure that you're financially healthy and you're tracking the right things to enable you to be successful. So as I say, too many agencies are suffering. I've been amazed at how many agencies, once we've got hold of them, you know, they've got great reputation and they might be presented nicely in the press and they win all sorts of awards and they're doing lots of good work. But the reality when you get under the bonnet is that they've got, many of them have got real financial challenges and they're struggling to build a profitable and certainly scalable business that they set out to achieve in the first place. Every business is trying to be unique or hopefully trying to be unique because that's what helps you stand out and cut through the noise. But there is definitely one thing that is absolutely unique about your agency versus everyone else on this webinar and everyone else in the industry. If you want to have a quick go at the live chat, make sure that's working. Let me know what you think it is that's definitely unique about every one of your agencies. Working exclusively with accountants, very good, I love that. The people, us, yeah, people again. A lot of people talking about the people. Yeah, lots of agreement there. So the one thing I'd say, people definitely, but the reality with people is that they can come and go. So we all want to build a fantastic team, but we don't own our people. We have no divine right for them to stay with us or work with us. And when people unfortunately do come and go, you can work hard on that, work hard on culture, and work hard on creating an environment where people are fulfilled and motivated. But the one thing that's unique about your agency that no one else can say, and it sounds strange, but it's the only one that's designed to give you the life that you want. There's no other agency out there that's going to give you the life that you want. Only your agency is going to do that. And I think as business owners, we often lose sight of the fact that we set up this business to give us the freedom, the money, and the time, control of our lives that we want. And several years in, we're often, the reality is that we're not getting that. And we lose sight of the fact that that's the only reason it existed in the first place. Yes, we want to provide fantastic service. We want to produce the best work, and we want to build a brilliant team, a brilliant culture. But let's not forget that this business was born in the first place to service you as the business owner and give you the life that you want. Otherwise, what's the point in it all? We want to do our bit, we want to contribute, we want to make an impact. We don't want to do that at the sacrifice of not enjoying our lives and getting the freedom that we want. So why are we talking about metrics and why they're fundamental to your agency? As I say, there's one thing that's definitely unique about your agency. You know, you want to give you the life that you want, but we also all want to make an impact. If you're getting all the financial reward and even the freedom, but you weren't necessarily seeing that you were making a significant impact on your clients, then you're likely to feel unfulfilled because you're not, you want to make a contribution. We only hear once, we only get one crack at this, and we want to feel like we've made a contribution to the world, and we've made our own little dent on it. And you want to be the best at what you can do. And for me, being the best at what you can do is not about winning awards, because there are lots of awards that get thrown out willy-nilly. People actually, these awards companies know very little about you. There's only one person that really knows how good you are at what you do, and that's you. And often we get frustrated that the thing that we're going out there and selling, the message that we're selling, we're maybe not necessarily delivering on it internally. And that's what keeps us awake at night. That's what frustrates us. And it's very important to us that as well as getting the financial freedom, that we as business owners are making an impact on the world and being the best at what we can do. So the metrics I'm about to share you are, from a financial perspective, part of the blueprint of not just competing. And I really want to stress the importance of this. When I put these agency insights together, it was initially born out of a request for us to start giving our clients an insight into how they compare against the industry. So that was the initial brief. When we started putting these reports together, the results, if I'm completely frank, were frightening. These stats that I'm about to show you today are the metrics and the results that the agencies that we working with that they were getting when we started working together. I guess we're putting ourselves on the line now because we want to make sure that we, in another year's time, we're reporting these numbers again and they're far better, because we've only just got a chance to start working with these agencies and we want to be able to improve their fortunes. But as I say, the reality was that the results are not great and are quite frightening. And what I don't want any of you doing is leaving this webinar thinking that the industry is in turmoil, that it's in decline, because your business is your business. It doesn't matter what other agencies are doing. It's what you can achieve. And if all you decide to do, if all you focus on is just trying to be 1% better than your competitors, then that's not a good strategy. It's not a unique strategy. It doesn't get to the heart of your business and what you're all about. So I don't want you thinking about competing. I don't want you thinking about hitting benchmark numbers and benchmark standards, because the reality is they're not good enough. I want you to be thinking about how you build the agency that you already know that you're capable of building, not the one that your competitors are building, the one that you know deep down you're capable of building. And maybe you just not made those difficult decisions yet that you need to make to finally get the agency that you're capable of building. So what you'll learn on this webinar, we're going to be going deep into discovering what these financial metrics are, which ones you should be tracking, so you don't waste time tracking the wrong things. I'm sure you'll all relate to this, but as I've grown my business, and I've seen lots of our clients grow their businesses, they've had tons of different dashboards and spreadsheets and pieces of software, all trying to figure out what the right metrics are that they should be tracking their agency, and they're constantly chopping and changing it. And the problem with that is that you're not necessarily moving forward, because you want data that you can consistently track and measure over time, so that you can see the improvements and see the patterns. And what we're going to help you to do today is to understand what those key metrics are, so you can just track the important few rather than the many. You're going to be able to understand how to calculate those metrics yourself, so you can begin reporting on them straight on the back of this webinar. And you're going to be able to understand what results you should aim for each metric, so you know how well your agency is performing. So again, when I say what results you should aim for, that is definitely not what results the industry is achieving. It's what results you should aim for with the business that you've built. And you're going to learn about the strategies available to improve each of those metrics, what you can actually do to influence them. So it's about understanding how to calculate them, what you should be aiming for, and the strategies to help you to do that. And then we're going to talk about overall our findings about what is and what isn't going well within the digital creative industry. So I wanted to start with talking about pricing, because when we talk about building a unique agency, a successful agency, a thriving agency, whatever you want to call it, there are very few businesses, not just agencies, very few businesses that charge a low price and are able to be successful. Because if you charge a low price, you leave yourself massively at risk to any volatility in the market, to any challenges that you have as a business, any setbacks, any cost increases, salary increases. It becomes very difficult when you are competing on price. You've got very little wriggle room, and sleeping at night becomes very difficult because the margins are so tight. Coupled with that, the fact that with those tight margins, you've then still got cash tied up in working capital, because you wait for people to pay you, you've got work in progress on your projects. If you're not able to charge a premium price, you leave your agency kind of very thin on the ground and very open to these challenges really doing what's happened this year and putting agencies out of business, or certainly very close to being out of business, because they've just got no room for error at all. And often what happens is that you come on a webinar like this, or you go on a course, and you already know a lot of this stuff. You know that you should be charging more for what you do, but then you go to the next prospect and you tell them about your new prices, or your existing client telling you your prices are going up, and you get challenged, you get knocked back because someone says you're too expensive. And that is not the justification to suddenly start reverting and dropping your prices again. Because just because you're too expensive for them doesn't mean too expensive for everyone. So just because one or two prospects or several have told you that you're too expensive, very, very rarely means that you are actually too expensive for the right clients. The reality is they were the wrong client, or you've not quite been able to articulate your value proposition. So I want you to think about, I don't want you to think about, you've already thought about this often. I want you to actually decide and go and build a value proposition so strong that you know exactly who you want. You know exactly who your service is designed to service, and you'll be able to charge a premium price for those people providing that service, and you can say no to everybody else. It really frightens me when I sit in front of agency owners and they say things like, we can do anything. You know, we are multifaceted, we're full service, we're full integrated agency, we can do anything for anyone. And I automatically get the shivers, and I'm very concerned, because that is not a strategy. Being open to everyone means that the reality is you're probably only going to be able to compete on price, and that's a dangerous game to be in, as we talked about before. So the question I'd like to think about is this. We talked before about people saying that you're too expensive, and often the reaction to that is to reduce your prices back down again. What if you didn't have that option? And what if, even more, you actually had to double the price that you're charging now? So I'm sure a lot of you see that, and it can be quite a frightening thought. But what if you had to double your prices now? If you had no other choice but to double your prices, and you still had to make your business work, what would your value proposition have to look like? And who would it be for? So you've got no choice to reduce your price to get more clients or to increase revenue. You can only increase your price. You've got to double it. What does your value proposition now have to look like, and who would it be designed for? Now, I'm not necessarily saying that you go and double your prices. If you can do that, amazing, brilliant. And that wouldn't be unrealistic for you to do that. Other businesses have done it successfully before. But even if you can't double them, if you can improve them by 10% or 20%, that's less clients that you need, that's less staff that you need, that's less chaos that you need, and you're improving your margins immediately by being able to increase your prices. So what would need to change about your business to enable you to do that? And if you think about it in terms of doubling it, and you're actually able to increase it by 10 or 20 or 30%, then fantastic. But it's because you've had that mindset of, I need to build a business that's given a far stronger value proposition than it is now. And by the way, that stronger value proposition, I'm not suggesting that you haven't got a fantastic service offering, but it's whether the market, I guess, are recognizing your service proposition and the value of it. So you might be great at what you do, but do the market see that, and are the right clients seeing your message and understanding the proposition? So if you charge a premium price, we've said it before, you attract the right clients and you attract the right staff. The converse of that is you charge a low price, it's very difficult to work with the right clients, and you attract the wrong type of clients, and it's hard to get good staff as well. So without further ado, the key metrics that you should be tracking in your agency, I'll just give everyone a moment to grab pen and paper or open up Evernote or whatever you use to make your notes. So real revenue per head, I think everyone's probably heard of the term revenue per head. It's very common, not just in the agency world, but in any service business. Our biggest cost is our staff. And if you're not generating enough revenue per head, then it becomes very difficult to make the margins that we talked about before. And if you think about, if you're not making the profit that you want to be, your options are either to reduce your staff costs, reduce your overheads, or increase your revenue. And none of us want to be reducing our staff costs. None of us want to be overly tight on our overheads, because we need to invest in order to grow the business. So really it comes down to being able to generate the revenue per person that you need to be able to achieve, to be able to afford all of those things. So to do this sum, simply take your revenue, deduct anything in there that's just procurement on behalf of clients. So if you've got your standard fee income, but then you've got things that you procure on behalf of your clients and charge a margin, then deduct the cost of those disbursements, so of those procurement costs from your revenue. So you get the real revenue that you're actually generating after you've deducted those costs. Typical examples would be things like pay-per-click spend, for example, or print. If that's included in your revenue, then take out the cost of that. So once you get your revenue figure, divide by the number of people in your business. If you've got a part-time person, let's say they do 3 days a week, they would be 0.6 of a person. If they're 1 day a week, it'd be 0.2, etc. So add up all the full-time and all the part-time staff and divide the real revenue by the number of staff that you've got. Shortly, I'll tell you what those numbers should be looking like. Your net profit margin, so how much of your overall revenue are you able to convert into profit? And if you're generating the real revenue per head that you should be, then logic says that you should be making the margins that I'm going to come on to shortly. If you're generating the revenue per head that you should be, but you're still not generating the margins, it means that you're paying more than the industry average for salaries, or you're investing more in overhead. Okay. Revenue growth. So I guess the term we've all heard before is that if you're not growing, you're dying. We can't stagnate because we've got inflation, and our competitors are growing, and our staff want to be paid more, and the costs of running our business are getting higher. So, and we're very much at jeopardy of any clients that we lose, any revenue that we lose. If we're not growing our revenue, then the only way we can ever go is backwards. So make sure that you are at least growing by a modest amount when it comes to revenue. Revenue is absolutely not everything. Net profit is the key figure. But if you're not growing your revenue slightly quarter on quarter, then you leave yourself very exposed. Accounts receivable days, so all the things at the top are about profit, and this one's about cash flow. So if you've got cash tied up in debtors or receivables, then however good your margins are, if that money isn't hitting your bank account, if it's not hitting your bank account, you can't run your business, you can't pay your staff at the end of the month. The quick ratio. So the quick ratio tells you how effectively you're able to settle your current liabilities out of your current assets. So in plain English, anything that you've got due to go out of the business in the short term, that you've got enough current assets, that's cash and debtors and work in progress, you've got enough coming in the short term to be able to cover those liabilities. If you're not able to cover your liabilities, then you're not able to stay in business. So you want to make sure that you're doing that. And then the final one that very few people think about, and maybe the most difficult one to get your head around, but return on capital employed. So what return on capital employed measures is the return that you're getting from your business relative to the investment that you've made in that business. As owner-operators and as owner-managed businesses, we don't often think about ourselves as investors in our companies because we run the company. But the reality is, whatever assets you've built up in that company, you are leaving them in that company to give you a return, and that return is net profit. If you didn't have your company, if you decided to sell the company or close the company down, you would take out all those net assets, convert it into cash and invest it elsewhere. So this is a really important figure because it tells us what return we're getting here for all the hard work that we put in and all the stress that we put into growing a business, versus what return would we get if we just stuck that investment onto the stock market or into property or into any other investment. And it starts to allow you to think about your business as an investment and not just a job. So real revenue per head, as I say, is the top line sales less any procurement cost borne on behalf of the client. And that'll give you your real revenue figure. The industry average is 57.7k from the analysis that we've done. And we believe from all of our experience and all the research and all the insights that we've got is that you should be targeting, and please write this one down, a 60-20-20 ratio. So 60% of your revenue should be spent on your staff. Bearing in mind that includes, as well as their salary, it includes the employee's national insurance that you pay on top of the salary. It includes their pension contributions that we all now have to pay under auto enrollment. It includes benefits. It includes bonuses. And if you get a really good, thriving team working productively, you're going to have to spend. This is obviously, I'm speaking very generally here. I'm not speaking specifically about your business, but on average, you're going to have to typically spend about 60% of that revenue on your staff, 20% of it on other overheads to run your business, your rent and rates, your advertising and marketing, your IT, your office space, etc., 20%. And if you do that, that'll leave you 20% left as a net margin, and 20% net margin is a very, very good margin to achieve for an agency. So although the industry average is 57.7k, I want us to kind of be mathematical about this. So what we've done is research what the average salaries are for an agency. And the average salaries come in at about £33,000 a year. And on that salary, if you look at the fully loaded cost, as I said before, with the pension contributions and the benefits and everything else, if you use that figure, that conversely tells us that the revenue per head that you need to be getting, a real revenue per head, needs to be at least 60,000. So that industry average there is not high enough for what it needs to be. If you're ever going to realistically achieve a 20% margin, you need to be doing well over 60,000 in order to ever, in reality, get that 20% net margin. So on to net profit margin. Net profit margin is a measure of the proportion of revenue that is left after deducting all expenses, and it's expressed as a percentage of revenue, and it excludes finance costs and tax expenses. So it doesn't include interest, and it doesn't include your corporation tax. So EBIT stands for earnings before interest and tax. The industry average, I'm afraid to say, is just 2.25%. And I think that will send a lot of shocks to people that are on this webinar today. I will caveat that with explaining that when we've taken the net profit margin, we've deducted the normal dividends that the owner managers are taking from the company. And the reason we've done that is because, as I said before, it's really important that you see that you have two roles in your company. You are a director employee, you work for the company, you provide service to the company, and you're also a shareholder. So a lot of people, when they measure profit, they've not deducted the dividends in order to get to the profit. But the reality is, for most small businesses, 99.9%, the dividends are just a replacement for the salary that you should be earning. So if typically you're taking £8,000 to £11,000 a year in salary, and you're taking 30, 40, 50,000 pound in dividends, that's probably still not enough for if you had to pay to replace yourself and pay a new managing director to take over your business. So the true economic profit of your business is different from what you'll see in your P&L. The true economic profit will deduct the true cost of replacing you as a managing director and paying your salary. And to work out that true cost, we've just deducted the dividends that you are taking from the business as a reflection of the kind of salary that you would need to pay. Okay, so once all that's been taken account of, the industry average are making very, very tiny margins of 2.25% after they've paid themselves, which is not enough. Revenue growth. So this, quite simply, I guess the most obvious one to measure the percentage growth in revenue for the period. And you and your board or your management team should be ensuring that revenue increases at minimum at a rate that's more than general economic growth, because that's how much it's going to, the cost of your running your business going to increase in salaries and overhead. So it needs, at least needs to be growing by more than inflation. However, the industry average first, the industry average 18.8%. That's pretty good, and I'll tell you why now. So there's a definition of a high growth company. So what I'm trying to do with each of these is not just tell you what the industry are doing, but tell you what good performance looks like. And there is a government definition of a high growth company that I think could be very interesting for you. So write this one down, please. A high growth company has been defined by the government as a company which grows its revenue at a rate of 20% or more per annum. So you're growing at 20% or more every year. You do that 4 years in a row, and you do that from a starting base of 1 million. So if you've got a £1 million agency today, and for the next 4 years, you grew by 20%, you grew the revenue by 20% year on year, you would be deemed by the government as a high growth company. I'm not suggesting that you should now have a strategy of being a high growth company. You may or may not decide to do that. But I believe that that's a better representation for you as to how fast you're growing rather than looking at the industry average. It just happens to be that the industry average actually is very close, which we would expect, bearing in mind the demand on digital and creative skills now. Return on capital employed. Return on capital employed is a measure of the efficiency and profitability of the capital investment. So as I said before, that's the profit that you're getting as a proportion of the net assets in your business. So if you've got a balance sheet that shows that you've got £500,000 agency and you're earning £100,000 a year, you would have a return on capital of 20%, because that's the profit you're generating as a proportion of the investment that you've got in that company, and you can compare that to investing anywhere else. The industry average is 10%, which you could suggest, compared to certainly being in the bank account, is very good compared to the return that you would get on the interest of being in a bank account. Compared to other investments, 10%'s okay, it's pretty good, but it's different because you're running a business and you're taking on a hell of a lot more risk and stress, and losing a lot of freedom for running that business versus investing it elsewhere. So you would expect, in a high risk investment like running a small business, you want to get a return on capital employed much higher than you would get anywhere else. Accounts receivable days, quite simply measure how long it takes for your customers to pay you from the invoice date, and the industry average is 55 days. So it's taking about 2 months for the industry to get paid from its customers. The big challenge there is that your biggest cost is your staff, and your staff aren't paying every month, I'm afraid. So if your staff need to be paid 1 month for all the work they've done in that month, but then your customers are going to pay 2 months later, it's no surprise that you run into cash flow difficulties. And that is all about working capital requirements. You might be very profitable, you're billing a good amount of work, but your customers are taking 2 months longer to pay you, then your biggest cost is going out, because your staff and your overheads tend to get your rent and rates often get paid sometimes in advance. Sometimes you're paying your rent 3 months in advance with some landlords, but at least every month, and your customers are paying you much slower than that. The quick ratio, so this is a measure of the ability to pay short-term creditors immediately from cash and debtors. So quick ratio of 1 to 1 is an absolute minimum. If anybody was researching your business on Companies House, one of the first things they would do is make sure that the company is solvent. So they'd make sure that you've got positive net assets. They would then look at the net current assets and make sure that you're able to service your short-term debt out of your short-term assets. So have you got enough cash and debtors to pay all the creditors that are going to need paying in the short-term future? So you at least want to have a ratio of 1 to 1, but really more like 2 to 1. So if you want to measure this in your company, just look at your balance sheet and take the cash and debtors figures and divide that by the current liabilities. Industry average 1.75 to 1. So that's pretty good overall. As I say, the problem is, going back to that last slide, is that often it's tied up in those receivables. So across your cash and receivables, you've got enough to settle your short-term liabilities. But if a lot of that's tied up in debtors, that's why a lot of agencies are having to move to things like invoice finance or use an overdraft to fund those receivables. There's my definition from earlier, which is obviously on the wrong slide. So overall, summaries from all of that are that we are seeing growth for the industry, but not necessarily growth for your agency. Because growth for your agency for me means growth in the amount of profit. And I know that sounds cold, but profit is the ultimate indicator of everything working. If you've got great customers providing great service, you've got happy staff, you're known in your industry, you're operationally strong, you're providing great value, net profit is the ultimate indicator that all of those things are working. You can't hide from net profit. It's very factual. And if you're producing profit, it's very unlikely that you've got a bad business, because there's no way that you would be able to demand the price and get the staff that you've got without being profitable. So the industry's growing, no surprise there. It's in demand. Revenues are growing at a rate that's almost in line with a high growth company there. So that's great. But as a reality check, the margins are woefully low, and nothing like certainly what I read in the press and what I've read from other benchmarking things that have taken place, benchmarking projects that have taken place. And what we've always wanted to do is make sure that we're very factual and scientific. If you ask all the agency owners around the country what their net profit margin is, they might not necessarily know what it is, so they're having a guess, or they might be embarrassed to tell the truth. What we've done is gone right into the finances and calculated it exactly, and it's nothing like what certainly we were told it would be before we started working with all these clients. And just as a bit of context, I guess, with those debtor days of 55 days, you would need to achieve a 15% profit margin just in order to survive on your own terms. So what I mean by that is, mathematically, if you're getting paid in 55 days, and you're achieving a profit margin of less than 15%, then you would have to use your current liabilities. So the money that you've got saved for VAT, the money that you've got saved for corporation tax, the money that you've got saved for any other creditors, any other accounts payable that you've got, you'd have to use that to be able to run your business. So the fact that the industry is achieving 2.25% profit and get paid in 55 days is why we're seeing all of these problems that we're seeing across the industry with sizable agencies as well. So there you go. So for me, it always comes back to pricing. What we said at the start is that agencies are not making the margins that we know that they're capable of, and the only way of increasing your margins is by reducing the overheads, the cost of running your business, or being able to charge more for what you do. We all want to run a great business, so we want to be able to pay properly for the things that we use to run our agency. So it all comes down to be able to provide the right services to the right market, so you can charge a higher rate and get paid for a higher proportion of the hours that you and your team work. So we talked about the higher rate, but that higher proportion is, again, a real challenge in the agency. Is just the amount of time that gets lost on work or not work if a lot of non-chargeable time is being spent. But also where you're spending chargeable time on clients, but it isn't actually being charged, so it's not being recovered, and that means that you're never going to be able to achieve the margins that your calculations show that you should be able to. So in terms of recovery, you must run a cost and capacity analysis so you can see the true cost of running your business every hour, every day, every month, and every year. So to do that, you want to understand all the overheads of running your business, and you want to understand all the time, the realistic chargeable time that's available from your people. And it isn't 80, 90%. The reality is if you can get your people 65 to 75% charged out, you're doing very well. So if you run some calculations, we've got a Profit Maximizer tool on our website which can help you to do this. You can understand what it actually costs for every hour that your people are spending in your business. And if you're not able to recover that cost plus a margin on top, then you can never be profitable. So you need to be able to understand those numbers and schedule that out and run those calculations. And then it's about filling that capacity and make sure you charge properly for it. And getting paid, of course, as we talked about before. The ways that you can improve this are ensure that you work to milestones that are controlled by you. So if you do the initial design on a website and you hand that to the client and wait for them to provide copy, it may take a week or a month or several months often, and you're waiting for them to respond to provide that copy before you can invoice them, that is really, really bad strategy, and it's completely unfair on your agency. if you've handed over a piece of work to a client because you've done that first stage, you need to be paid for that first stage. The fact that the client hasn't done their bit is irrelevant. They're not paying you for them to write the copy. They're paying you for you to have done the design. So at every stage in a project, it's really important that you get the invoice out and you get paid quickly. If the client then delays, then they're just delaying the next part of their project. They're not delaying you being able to invoice them. So make sure that you review your project milestones and ensure that they are milestones that are controlled by you and not by the client. And then invoice on achievement of defined milestones. So rather than saying we're going to invoice every month or every 2 months, every 3 months, if you can invoice based on when we achieve this, but this is achievable by us, then your team are now incentivized and motivated to become efficient and get work done so that you can get those invoices out the door. And the more efficient you become, the better your cash flow gets. Get paid via direct debit. A lot of businesses don't believe you can get paid by direct debit, but there's very, very simple direct debit solutions available now, such as Go Cardless and Stripe, which will enable you to automatically collect payment for your invoices from your clients. Now, of course, that needs to be agreed with them up front, both verbally and in your terms and conditions, because if you just stick it in terms and conditions and hope they don't read it, then you're going to end up arguing further down the line. It's going to cause trouble. So just be very upfront that this is how we get paid. This is also a real good test of clients that are serious about working with you, because if they're not happy to pay by direct debit when your invoice comes due, and what they're saying is that when you've done the work that we've agreed and you've invoiced what we've agreed, that we're not happy to pay you on time. And that's obviously a big red warning sign. So putting direct debit in place ensures that even if you're getting paid on 30 days rather than 14, for example, at least you know when you're going to get paid. It's going to be automatic. It saves you a whole lot of headaches about chasing up for payment. And I'd like you to push for 14 days payment terms. I know this isn't necessarily always possible for when you're working with big companies, and that's often why people use invoice finance, so you can get into the big companies, and I get that. But as a default, that's what you should be setting, because you can't lose. If you set 14 days payment terms, they challenge you, then you can start negotiation, but you're never going to get 14 days if you never ask for it. If you start at 30, then you'd be very lucky to get 45. Whereas if you start at 14, certainly for small businesses, they will often be dictated by your terms. If they believe enough in your value proposition, keep coming back to that, is that if they can't live without you, which is what you want, that's the ultimate strong value proposition. When they can't live without you, they're much more likely to want to pay you quickly. So to round up, I said at the start that this is about taking control of the business that you set up all those months or years or decades ago, and reconnecting with the fact that this business was built to serve you. Unlike any other agency, this one was built to serve you and serve your family. And if you can have that sort of focus and think about, therefore, how do I double my prices, you'll start to build a value proposition where, do you know what, you will be wrong, you won't be right for a lot of businesses. And it's in those decisions and that discipline where you start to attract the few that adore you rather than the many that cause you trouble. And it's those few that adore you that are going to give you the lifestyle that you want, that are going to give you the staff that you want, that are going to give you the brand that you want, that are finally going to enable you to build the business that you always wanted to. And I just want you to take action. You've heard lots of stuff like this before, and often you never feel like it can happen to you. You never feel like you can have that incredibly successful business that makes massive margins because everyone else is struggling. But it's not true. If you focus and stay disciplined on executing your own strategy, you can build the lifestyle and the business that you've always wanted to, but you need to be able to take action. How long will you delay giving you and your family the life that you deserve? How long will you keep saying, yes, I need to do that. Yes, I need to think about that. Yes, I need to revisit it. Or conversely, when are you going to make those difficult decisions and say, I need to do these things now? No one determines the success of your business as much as you do. Lots of people quick to blame the government, quick to blame politicians, competitors, staff, mentors, advisors, suppliers, clients. But the reality is no one controls your own success as much as you do. You're an entrepreneur, you're a business owner. You have the ability to wake up any day and decide what you want to do. The meetings that you want to have, the people you want to speak to, the work that you want to do, it's entirely decided by you. And what often happens is that we're trying to please everybody and we work to other people's agendas and other people's diaries, and we're not doing the things that we know deep down we need to be doing to build our own businesses. As entrepreneurs, you have the ability to do that. So, quick recap. We discovered which financial metrics you should be tracking for your agency, so you don't waste time tracking the wrong things, because there's lots of things that you can be tracking, but there's a few that really make the difference when it comes to financial metrics. Obviously, I'm just talking about financial metrics here. There are very important sales and marketing indicators, people indicators, customer indicators, operations, but today we're just talking about financial metrics. You now understand how to calculate those. I talked you through how to calculate each of those, but we will be sending out our Agency Insights report after the webinar as well, so you'll be able to look through that in a bit more detail. If there's any questions, always get in touch and let us know. You understand what results you should aim for, not just what the industry is achieving, but what your business needs to deliver in order to achieve its goals. And we learned about some of the strategies available, particularly in terms of pricing and collecting cash in order to achieve the metrics. And we talked about the fact that the industry is achieving growth. On the face of it, agencies are solvent in that they can practically settle their current liabilities out there, current assets, but they're not necessarily making the margins, and the cash isn't actually coming in quick enough. So what's next? Nothing that I'm going to certainly sell on this webinar. All I would say is that everything that we've talked about here, we are now going to be tracking on a quarterly basis for all of our clients that are on our management account service. So if you get management accounts from My Accounts Place, within 7 days of your month end, you receive a simple PDF explaining your management accounts, and you also receive a video talking through those, a 6 to 7 minute video from your My Accounts Place FD. What you're now going to get for no extra cost is every quarter we're going to be assessing each of these KPIs and how you are comparing to the industry in a nice visual report that you can easily understand. And that will be delivered via a report and a video every quarter as well. So if you're an existing client of My Accounts Place, nothing for you to do, nothing for you to pay. That's just going to now be added onto your service free of charge. If you've not got management accounts, then speak to your client FD about the practicalities of doing that, and you'll get access to the same thing. And if you are not a client of My Accounts Place yet, then feel free to book a discovery call, and we look forward to finding out more about your agency and whether we're a fit and whether we might be able to help you. But for now, that's it from me. There's all my contact details, so feel free to reach out, email, Twitter, LinkedIn, whatever works best for you. And we're just going to jump into the questions, Beth. Okay. John asked one question: what is the scope of the agency involved in calculating industry average? How many are included, and is there an average size or turnover? So let's go through those one at a time. How many are included? So in this research, we've included only about 25 clients, because we've got 25 clients at My Accounts Place who are agencies and who are receiving monthly management accounts from us. And therefore that's what we've been able to accurately be able to present. If they're not on management accounts, then we can't necessarily, we definitely can't reliably track things like the real revenue or the net profit margin if they're not getting the month-end journals and they're not getting the adjustments done at month-end. So there's about 25 clients, John. Is there an average size or turnover? The average size of these clients, these 25 clients, I would say is probably about £600,000 to £700,000 turnover a year. So the smaller ones are doing a couple of 100,000, and there's some on there that are doing, the biggest ones are doing about 3 million. So I hope that answers your question, John. Have we got more questions on the chat there? Okay, chat, let's have a look. Are you circulating the slides, Paul? Can we do that, Beth?
We can do that afterwards.
Yeah, so we were just going to send out the Agency Insights report. I think we'll just send the Agency Insights report out, Mike, because that's a more detailed version of the slides anyway. Mark, I'm not going to use anyone's surname here, don't worry, but Mark, 33k including all benefits. No, 33k is the salary, Mark, and then you need to include your benefits and any other costs of your team before you work out those numbers. So £33,000 is the basic salary, and then there's other things on top. Stuart reminded me about the high growth figure is starting with 10 employees. So it's a starting base of 1 million and 10 employees to get you 20% growth year on year for you to be a high growth. Thank you for that, Stuart. You're the one that taught me that. Mark, does the revenue growth stat need to take into account overhead or ratio cost? Not sure what you mean by that, Mark. I'll probably pick up on that with you after, if that's okay. Colin, is the real revenue per head calculation based on all staff or just direct staff? Are you including overhead staff in the divisor? Yeah, all staff. Great question. So the real revenue per head is the revenue that you need to generate for every member of staff. So conversely, if you've got your revenue, you need to divide by all the staff in your business, and that's what you need to achieve in order to cover all their salaries and their overhead. Stuart's come in and said that. Yeah, brilliant. Good that we agree, Stuart. Phil, question for later. To what extent does London skew the average? London doesn't skew the average at all because none of these agencies are London based. Nearly all of them are Northwest based. And I'm just looking at our list now. There's one in Yorkshire and the rest are in Northwest. There's none in London at all. And again, that's why we wanted to be able to do this ourselves, because we've seen lots of other reports, but we wanted to look locally at what's actually being achieved. So London doesn't skew the average figure. Should agencies outside London be aiming for slightly lower minimum figures? No, they definitely shouldn't, because that figure of £60,000 per head is based on the average £33,000 salary that we know the industry is paying across the Northwest. So it's a very scientific calculation. So you need to be doing at least 6,000 a head. Simon, can you give some background on the companies that the data came from? I think I talked about that. How many companies? About 25. Average revenues, about 600,000, 700,000. Staff numbers, well, you can kind of work that out from the 600,000 to 700,000. So they tend to be, our clients, 5 to 30. Location, Northwest. Core services a range really. They're all agencies, they're all digital creative or marketing agencies, so they're doing everything that you would expect from digital creative and marketing. Stuart, if you want usable metrics, ask Paul for the cost of introducing the Fathom report to your business. There you go, Stuart. Yeah, I gave the answer to that. The cost is nil. If you're on management accounts, you now get them for free. I agree the profit is the number one metric to track. Therefore, would you say that turnover is vanity, profit is vanity, cash is king is a bit outdated nowadays? It's not outdated, Tom, because it's still valid in that profit is essential in order for you to be able to generate cash, but you still then need to be able to convert it into cash as well. So there are profitable businesses every single day that go out of business because they run out of cash. And some of the agencies that have gone bust this year were profitable, but they couldn't get cash in quick enough. So cash is still ultimately king, but you can't get cash without profit. And I think, Beth, tell me if I'm wrong, but that's all the questions.
Yeah.
Feel free to reach out on Twitter, LinkedIn, email, whatever you like. continue asking questions. The report will be sent over to you tomorrow morning. So let us know your thoughts on the back of that, any other questions you have there. Thank you, everyone. Thank you for saying thank you. Thanks, Colin. Thanks, Tom. Thanks, Kath. Thanks, Stuart. Thanks, Amanda. Thanks, John. Thanks, Warren. Thanks, Alec. Thanks, David. Thanks, Phil. Thanks, Laurie. Thank you, Steve. Thank you, Nazir. Thank you, Frank. Thank you, Jerry. Thank you, Andrew. Mark. Thank you, everyone. Hope it was useful. Thanks, Joseph. I hope you all feel like you've got something you can go away and actually implement straight away. There might be some confusion over running the calculations. If there is, just reach out and we can happily show you how to do that. Just give us a call, drop us an email, reach out on social media. It's not a problem. We can help you with that. Okay, everyone, I think we're about done. I'm going to close off now. We'll get the email over tomorrow morning, so watch out for that and let us know if there's anything we can help you with in the meantime. Thank you.